Hi there, my name is Nhyira Premium and welcome to the Business Lecturer in Within Show and welcome to my series on business finance. This is the part 2 or the second session in the series. So if you didn't watch the first session of the part 1, you make sure that you watch that on my page, on Facebook, on Instagram or on YouTube. All of these are, the name is Nhyira Premium. Now, so we want to continue with the pecking order theory and we look at retained earning. Now we want to look at raising finance from debt. Now, when it comes to debt finance, we can raise various forms of debt, or there are various types of debts that we can talk about. We have bank loans there, we have debenture notes there, we have the loan notes there, we have the zero discount bond, and then the deep discount bond. Now, the difference between a zero discount bond and a deep discount bond is that with the zero discount bond, what happens is that there is no interest that the bondholder receives during the life of the bond, but upon redemption, a premium is paid or the bond is redeemed at a premium. So what does that mean? For instance, if we issue a zero discount bond, what it means is that with that bond, we are not going to be paying any annual interest. Rather, on redemption, we will redeem the bond at a premium. So an example can be that we are issuing a 6% loan notes, right? Loan notes, and it's redeemable in 6 years. But it's a zero discount bond. Now, in 6 years' time, let's say the loan note is $100 or $1,000. In 6 years' time, when we are redeeming, we will pay the bondholders $1,750. So that is what? A zero discount bond, alright? So with that case, you ain't going to be receiving any interest. Now with a deep discount bond, it is where you're going to be receiving some interest, but it's not going to be the normal interest. The interest on the annual payment you're going to be receiving is going to be lower than how much you should have received, and also with this one, on redemption, it will be redeemed at a premium. But then when it comes to looking at long-term source of finance and we are looking at debt, so we can go to the bank. Now when we go to the bank to borrow money from the bank, then the cost of the debt is the interest rate at which the bank gave us the loan. So that becomes the cost of the debt. That becomes what we call KD. If we issue a loan note, that is also going to be a different thing. So in the determination of the cost of debt, we need to ask ourselves a question. One, we need to ask ourselves whether the debt is irredeemable or redeemable. Because if the debt is redeemable, calculation of the cost of debt is going to be different. And then if the debt is also irredeemable, calculation of the cost of debt will also be different. So how do we go about it in relation to that? So if the debt is irredeemable, then our cost of debt, which is represented by the symbol KD, is going to be I over PO. Now I want you to stay with me, Claire, here. Think this has a reflection. Let me see if I can go here for you to see better. So KD will be equal to I over PO. Now, this is KD without tax, okay? Without tax. So the KD is the cost of debt. The I there is the interest on nominal value of the bond. Please note that the nominal value of a bond is always $100 or 100 Ghana cedis. Whether the examiner tells you or not, the nominal value of bond is always 100. What does that mean? It means that when you are calculating KD, the interest you bring here will be the interest rate divided, multiplying by what? The nominal value, which is what? 100. And I'm going to solve an example for you right now. So this is KD without tax. But you see, the truth of the matter is that debt is tax deductible. So always we have to calculate KD after tax. So if we incorporate tax into this formula, then KD will be equal to I over PO 1 minus T. Okay, so I is the interest, PO is the market value of the bond or of the debt. Okay? So PO is the market value of the debt. So we bring the interest divided by the market value of the bond. Now remember, this will be times 100 because our answer has to be expressed in percentages. So it's going to be times 100. So this is how we calculate the KD for what? An irredeemable debt. An irredeemable debt. So if the debt is irredeemable, then we calculate the KD using this formula or that formula, depending on whether there is tax in the question or not. If there is tax in the question, we have to calculate the KD after tax. Now remember, this formula is also times 100 because I just told you that the formula has to be represented in percentages, or the answer has to be represented in percentages. So let me pull a scenario up and let's see how we can go about it. So let's say PEC PLC or PEC PLC has, or let's say issued a 6% debenture note, 6% irredeemable debenture notes at market value, or debenture notes quoted at $103.5. If tax rate is 25%, I calculate KD without tax. I KD with tax. So this is the scenario, and the examiner is asking us to calculate KD with tax and then without tax. So first, with KD without tax, we said KD equals I over PO times 100%. Now remember what I told you. I told you that the interest is always on what? $100 nominal. So when you take 6% times 100, that will give us $6. So our answer will be $6 divided by the PO, the market value of the bond, which is $103, $103.5 times 100%. So let's punch that out. I have my Casio here. So 6 over 103.5 times 100, and that's 5.8%. 5.8%. All right. So that is how we calculate the KD without tax. What about a KD with tax? KD with tax, what do we do? In a simple scenario, we're just going to bring our interest rate 6, market value 1.03.5, 1 minus the tax rate 25%. Then we punch it out, all right, to get our answer. So that's going to be 6 over 103.5, bracket open, 1 minus 0.05 or 0.5 times 100%, and I'm getting 4.3%. So that is how we calculate KD for irrecoverable or irredeemable debt. I hope it is simple, right? So with tax, without tax, boom. Now this formula will be given to you in the exam hall, but you have to also know about it. So I'll see you in the next video as we talk about the next thing. See ya.